Good afternoon. I'm Chris Andrews, Vice President and Head of Funds Management here at Trobe Financial, and today your moderator. We're pleased to again welcome a large number of people from across Australia for our quarterly investor call briefing. We greatly appreciate your interest and ongoing support in our investment operations here at Trobe Financial. Today we intend to cover the following topics. First, domestic macroeconomic issues and their impact on your investment performance. We'll focus in particular on key economic indicators and drivers like unemployment, inflation and interest rates. This section will incorporate our much discussed headwinds and tailwinds report. We'll also consider the international economic outlook and any relevant impact for investors. Secondly, we'll give you an update on the Trobe Financial Group, a quarterly health check, if you like, on the group and its operations. And thirdly, we'll look at our retail investment fund and how, in particular, that fund has performed for investors. Now, you should be able to see on your screen where you can type in questions. With the numbers we have attending today, we may not be able to get through all of the questions during this half hour. We're really pleased with the uptake that we've had for this quarterly investor briefing. We will answer questions on a first-come, first-served basis at the end of this presentation. If there's any questions we can't get to for time reasons, then we undertake to follow up with you personally after the teleconference. Importantly, and I should stress this point, we're seeking to provide this information in an interactive forum so that investors and investment professionals can have the opportunity to ask questions in relation to the matters that we cover today. We therefore cannot comment on individual assets, individual investments today. But of course, as always, our investor sales team is standing by, ready to assist you on these matters on 1-800-818-818. So with any of these queries, we'd really suggest that you give them a call and they'd be delighted to assist you. Now, we've got plenty to get through today and appreciate that you're all on very tight schedules, so we'll keep this presentation to half an hour maximum. And we will commence first with economic issues and our headwinds versus tailwinds report. And the theme of this quarter's headwinds and tailwinds report is separating the headlines from the underlying trend. Because quite frankly, if we just looked at the headline figures, if we just looked at the headlines in the papers and so on across Australia at the moment, this would be quite a sombre report. And frankly, in our view, that's not reflective of the reality of what's going on in the Australian economy at the moment. Whilst we and those who have dealt with us over a period of time will recognise this, we generally try to avoid making predictions about future outcomes and I guess falling for the trap of over-precision in what we think will happen in the future. There is enough positivity both internationally and domestically to suggest that things might not be quite as bad as the current headlines might suggest. On screen we see a summary of our headwinds and tailwinds report. We'll go through each of these factors in a little bit more detail now. So, our first headwind today is subdued domestic growth. And with headline media news, well, we've all heard lately about the withdrawal of Toyota, of Ford and of Holden. We've heard that it's affecting something like 45,000 jobs directly and up to 248,000 jobs indirectly. We've had news of the goings-on at SPC, see the ongoing saga at Qantas seeking handouts. One could draw the conclusion that things are pretty grim in corporate Australia. So domestic growth is still down as a headwind for Australia and investors as well at this point. Looking at the headline figure in the low to mid 2% range on screen, you can see why this would be the case. There are, however, real reasons to be more optimistic than the headline suggests. Retail sales and household consumption both improved in the December quarter, which gives the first real signs of increased life in the non-mining sector. Now, this has actually prompted the RBA to increase its growth forecast from 2014 from 2 to 3%, which is where it was at in November, to 2.25 to 2.35% a fortnight ago. Now, no mistakes about that. That's still not spectacular. Treasurer Joe Hockey said we need more than 3%, and certainly over the last 50 years we've averaged around 3.5%. But the movement towards non-mining based growth is a significant positive. It may even be a watershed moment for the Australian economy, and we'll be watching this closely to see if the trend continues. Then there's international growth, and whilst growth of our major trading partners is still lower than in the pre-GFC boom times, it's actually now not too far off the 15-year average, and it did improve through 2013. You can see the headline numbers for the December quarter on screen. You can see, for example, behind that tiny growth rate of 0.3% in the Eurozone are stats like negative 2.4% growth in Italy, 0% growth in France, and so on. Similarly, behind the headline unemployment rates, so 12% in the Eurozone, you've got 25% in Spain, including, and this is a real problem for Spain, a generational problem, 54% unemployment amongst Spanish youth. So global growth is still down as an overall headwind. But we're still going to be watching this very closely to see whether 2014 is the year that began the turnaround in the world economy. And certainly the World Bank has already declared a turning point, and it's done it both for the advanced and the developing economies. And in fact, the World Bank's predicting acceleration of growth through 2014, 2015, and into 2016. So, look, growth is still down as a headwind for the global economy and by extension for Australia, but we might be seeing the first signs of life on the world front. So that's sort of the positive behind the negative, if you like. Our third headwind is domestic unemployment. Now, obviously, unemployment hitting its highest point in a decade at 6%. That's no doubt about it. That's a headwind. But again, there is cause for some very cautious optimism. Unemployment is typically regarded by economists as a lagging indicator, and if the increased retail spending observed in the December quarter continues, we may, just in due course, it won't happen immediately, won't happen overnight, but it will happen, as the famous commercial says, we may in due course start to see this positively impact the unemployment rate. Now, on this front, much will continue to depend on the exchange rate. Our exporters in particular obviously will continue to struggle while the Australian dollar sits at its current levels, sits around 90 cents US. And focusing on the Australian dollar, we have included that as a headwind on the basis of its impact on our exporters, and although we do so somewhat cautiously. The IMF assesses the dollar as being 5 to 10% higher than it should be, although these target prices are notoriously uncertain, it should be said. It should also be noted that Australian consumers are going to experience quite a shock at lower levels. You know, there was some prediction in the press yesterday, as recently as yesterday, saying that the Australian dollar may crash quite quickly towards 66 US cents. A lower exchange rate is not the unmitigated good that it's often made out to be, and the Australian consumer will experience that if we do see a sudden downward movement. It should also be noted that there is a cadre of commentators, and in recent months probably a growing cadre of commentators that are tipping a reappreciation of the Australian dollar back to around or even maybe above parity with the US dollar. Obviously that'll depend on how the US economy goes and how the Australian economy goes relatively, and that could take in the success that we have in exporting our LNG with some massive capital works and LNG programs coming online over the next couple of years. So predictions as to the Australian dollar are difficult, and we will still keep the Australian dollar, the strong Australian dollar, down as a headwind for now, noting that a depreciation in the dollar is not an unmitigated good. Our final headwind is, of course, the role of government, and both state and federal governments continue to have significant budgetary issues. There's no doubt about that, and that is down as a negative, as a headwind for the Australian economy. Now, short-term fixes are going to continue to be tempting. Whilst asset sales raise money, at La Trobe Financial we'd prefer to see them based on principled assessments as to whether the government or private enterprise can most productively utilise those assets rather than a desire for a one-off fiscal hit. So the challenge for all governments will be to meet the nation's considerable infrastructure needs without further impairing the budget bottom line. Okay, so that's the headwinds. That's those things holding back the Australian economy. What about the tailwinds, those factors that are driving us forward? And there are many. The first point I'd make, before we dive into them in too much detail, is that the same situation in some respect applies with reverse to all the headwinds. Some headline numbers that look good can conceal some underlying softness and challenges. Take inflation. It still looks well within the RBA target range of 2 to 3%, and on that basis is down as a tailwind. However, that good headline figure conceals the fact that non-tradable inflation, which is to say domestic inflation, this has been running at around 4% for a decade. Now, if this is a structural issue, we're going to have real problems, because if the exchange rate depreciates, we will experience an inflationary shock that will be extremely challenging for policymakers. So watch this space. Next is low interest rates, and there's little doubt that interest rates sitting at 50 years low, they're good for borrowers and for economic activity generally. The RBA has at this level, if you like, a lot of ammunition to throw at any inflationary issues while still maintaining interest rates at manageable levels. On the other hand, negative real returns on cash are a disaster for savers and retirees. In fact, some commentators have described the extraordinary interest rate settings across the world over the last 5 years or so as being nothing more than a massive redistribution of wealth away from savers and towards borrowers. In fact, even relatively conservative writers like Robert Gottliebsen now are decrying the overexposure of many investors to cash on the basis that the cash rates are simply insufficient to meet their retirement needs. Interestingly, according to UBS data, many of the worst offenders in this category are the young and the wealthy, who appear to have focused their investment strategy entirely on minimisation of capital risk. Negative or zero real returns, of course, over the longer term, expose investors both to inflation risk and to longevity risk or investment adequacy risk. So this development is something of a concern for Australia and for Australian investors. A real tailwind behind Australia, of course, is the strength of the household balance sheet. Post-GFC, Australians collectively responded with an extraordinary and seemingly permanent shift to sustained higher savings, and you can see that very clearly from that very striking graph on screen, which is from the RBA chart pack. The consequences of this higher saving rate have been many. On the negative side, obviously, our retailers have felt the pain as the Aussie consumer has closed his and her wallet. On the plus side, however, we've now been in a 5-year period of balance sheet stabilisation at the household level. Mortgage heads are strong, and the Australian borrower looks really well positioned to deal with any future economic shocks. So that's a really strong tailwind for the Australian economy. Dwelling prices have increased by 10% nationally over the last 12 months, and many believe this is contributing to the shifts in consumer sentiment that we've detected and have just discussed. In particular, Sydney saw strong growth at 13.4% over the 12 months to the end of December, and in fact is still experiencing low stock on market levels. Now that suggests there may be further to run in its price adjustment. It should be noted, however, that this comes after a relatively flat decade for Sydney of price growth, so there is an element of catch-up going on here. After that, well, Perth and Melbourne were also strong, while the rest of the capital cities grew only very slowly in terms of housing prices. In fact, in real terms, very slowly indeed, and sometimes negatively. Pausing there for a moment and focusing on dwelling prices, we've frequently asked our view on the Australian housing market and its prospects. Again, as I say, we don't position ourselves as market soothsayers, but some basic points can be made. First, and I hope that this point is obvious, there is no one single housing market in Australia. There's a patchwork of smaller regional markets, all of which are subject to their own unique drivers. Secondly, and building on this, as we've discussed, the strong performance of housing last year was due in large part to Sydney, with also Melbourne and Perth playing a role. Sydney was in catch-up mode and may still have some way to run on that, although the indicators are at this point starting to diverge. Stock on market is still low, as I said, and that suggests there is still some way to run yet. We've got prices as a proportion of income, on the other hand. They're nearing all-time highs. So there's a couple of divergent indicators there that we're going to watch carefully. To avoid the risk of the Sydney market overheating, frankly, we'd like to see some moderation in the proportion of investors buying into the market as compared to owner-occupiers and first home purchasers. Overall, barring shocks, we'd expect to see solid price growth in Sydney. Melbourne's been a very solid performer over a number of years now. Didn't have the spectacular run that Sydney had in 2013, but still registered solid growth. Auction clearance rates are strong. Overall, Melbourne has probably less scope for increases, particularly with a strong ongoing supply of new apartment stock. We expect probably more moderate growth than in Sydney, with established houses close to the CBD and perhaps in the middle suburban ring being the strongest bets for growth. Perth, on the other hand, is at a crossroads. We've got mining investment beginning to slow in favour of the less labour-intensive operational phase. Now, that's interesting because in itself that may increase unemployment, but on the other hand, that same phenomenon may result in more people returning to Perth from regional areas and requiring housing. So there's sort of a contradictory drivers there. So it'll be interesting to see how Perth plays out over the next 12 to 18 months. Brisbane and southeast Queensland have struggled for many years. Now that, to an optimist's eye, suggests the possibility of future growth. Certainly we've got the 2018 Commonwealth Games, which will increase investment on the Gold Coast, and we're seeing the first signs of recovery from a multi-year slump there on the Gold Coast. Like Perth, predictions about southeast Queensland are more difficult to make, but the upside is probably at this point beginning to look more likely. Finally, the smaller markets, so Adelaide, Darwin, the ACT, Hobart. Now they seem less likely to grow this year, but are always more subject to unexpected rises and falls. And you could say that for the regional areas as well. Finally, the final tailwind that we'll discuss today is population growth. Now obviously this is a complex issue. It cuts across a range of policy areas, and we've discussed that in the past. From an economic perspective, however, there is no doubt that a growing population generates more demand for goods and services and drives economic growth. It's a little commented upon fact that during the GFC, Australia actually experienced a per capita, a per head of population recession. It was only population growth that kept us out of recession territory. So population growth is a tailwind for the Australian economy. And that in a nutshell is our headwinds and tailwinds report. As you've heard, we're still cautiously optimistic. Look, Australia faces challenges, but it is still a great place to live, to work, and to invest. So that's the economic picture. Now turning to the La Trobe Financial Group update, and we see that the December quarter was a huge quarter for the La Trobe Financial Group. Some key highlights include a host of awards and recognitions, including the Pooled Mortgages option being awarded the best mortgage fund in Australia from which is a prestigious award handed out by Money magazine each year. That's the 5th consecutive award for the Pooled Mortgages option, which is an outstanding achievement and is unmatched by any manager in the sector in history. La Trobe Financial also finished as a finalist in the Australian Lending Awards, and La Trobe Financial CEO Greg O'Neill was named one of the top 50 influencers in social media and financial services, which reflects his long and thoughtful contribution in this sphere. We've had the International Alternative Investment Review in Hong Kong awarding La Trobe Financial as the best mortgage fund manager, which is a prestigious international award and signs that we are recognised both domestically and internationally. We have our external ratings in place. They've been reconfirmed. Of course, as we always say, ratings are only one factor to consider in investing, and you can view our ratings papers in full on our website at latrobefinancial.com.au. At an operational level, we've reworked our investor statements based on feedback we've received from our investors to make them more intuitive. We've secured our Melbourne premises for a further 10 years, which is a good sign of the solidity and the long-term view that La Trobe Financial is taking, our overall positivity about the investment market in Australia. We're actively considering opportunities to expand our Sydney presence, and you'll see us firmly committed to that strategy over the next 12, 18, 24 months. And we're celebrating our 5th year in our Shanghai office, which is a good sign of our commitment to that international strategy and the success we've achieved in that international strategy. In terms of distribution, well, our strategy has been very effectively executed in the December quarter. We were among the first Australian fund managers to receive funds under the Significant Investor Visa program, and in fact attracted a lot of media attention on that front. Recently, our Chief Wealth Management Officer Randall Williams presented on this subject at the Malaysian Consulate in Melbourne, and then we followed this up with a presentation to high net worth investors in Kuala Lumpur, Malaysia, which was extremely well received. March is going to continue to be extremely busy for us. We're going to be presenting at a roadshow of over 1,000 advisors in the key Australian capital cities, so that'll be really important to reach out to our advisor partners. And we will also be participating in government trade missions to China and South Korea, and potentially further high net worth investor seminars in Malaysia. So it's a very busy month or so ahead of us to finish off this quarter, and really pleasing developments on all fronts. Financially, the group remains extremely solid. Net assets are up to 68.5 million at 31 December, which is a really strong asset position for the company. Funds under management have increased to 638 million across over 20,000 registered members. Really pleasingly, we've also transitioned another fully funded portfolio of loans and investors into the La Trobe Australian Mortgage Fund that totalled 79.7 million in funds under management. So a really pleasing group outcome there. Finally, to our fund and our fund performance update. You can see on screen, just as a quick refresher, the 4 options in the Trobe Australian Mortgage Fund. Again, as a high-level refresher, all 4 are segregated from each other, so an investor in one option, for example, is not affected by investment decisions made in other options. The options can be divided further into 2 pooled and 2 contributory options. Now, the contributory options, you can see on the right of the screen, the direct mortgages and high-yield mortgages options. These allow investors to choose the individual loans in which they are investing. So these options work really well for investors who want to take control, who want to select the individual mortgage-backed assets themselves, and so, you know, potentially self-managed super funds have been big adopters of this form of investment. Also allows investors to take on a higher risk-return profile and enhance the yield that they're receiving in their portfolio. Our pooled options, well, they're more like your traditional mortgage funds, so you can see them on your left, obviously with our own distinctive approach to this asset class. So you see our cash and mortgages and pooled mortgages option. The cash and mortgages option, or CMO, is a segregated pool of cash and mortgages paying a variable rate of return that's currently 4.2% per annum. Stress again, as we always do, we are not after hot money in this account. In fact, the cash and mortgages option was started as a holding vehicle for investors who were between direct investments. The pool mortgages option, well, that's got $250 million in funds under management. It holds independent ratings from Zenith, recommended, and SQM Research, superior, or 4 stars. As we mentioned earlier, the pool mortgages option, or PMO, was awarded Best Mortgage Fund in Australia for the 5th consecutive year. So really strong awards, recognitions, strong ratings from independent ratings agencies. It's really been a terrific performer for La Trobe and for its investors. We just stress again, as we always do, neither of our pooled options have ever frozen redemptions, and neither have ever returned a cent of loss to their investors. In reporting returns, we focus obviously on the 2 pooled options. The performance of the direct and high yield options obviously depend on the individual investments in which investors are invested. So the 2 pooled options being the cash and mortgages option again, so that's CMO, and the pooled mortgages option, or PMO. As you can see, across the December 2013 quarter, the CMO delivered an annualised return to investors of 4.2% per annum. The 12-month term investment PMO delivered 6.15% per annum. So that equated to a margin over benchmark of 1.70% and 2.09% respectively. CMO's benchmark is the official cash rate, being the best proxy for its performance profile over time and the most relevant comparator for investors. The PMO's benchmark is the UBS Bank Bill Index, which is, of course, a common benchmark for cash-correlated fixed interest type investments, plus a margin of 1.5%, which reflects the risk-return profile of the PMO. We've also provided on the right of the screen the longer-term performance profile of the 2 options to highlight their extraordinary consistency over time. Obviously, whilst past performance is no guarantee of future performance, this sort of profile is what we are striving to achieve for our investors. So we're extremely pleased to present it to you. Graphically, we can see the PMO's return against various 12-month term deposit indices over the last sort of 3.5 years or so, really that period which has been described as the hunt for yield territory. Over the quarter, the December quarter, PMO averaged a margin of 2.78 over the average 12-month term deposit rates of the big 4 banks, which you can see on screen as the black line. That is extremely powerful yield-based performance for investors. Similarly, you can see CMO's returns in comparison to key online account indices. Stress again, we do not chase hot money for the CMO, but you can see its strong and competitive performance in comparison to the top online accounts. Obviously, I should note that, like the rest of the fund, the CMO and the PMO are not bank deposits and they're not subject to the government deposit guarantee. Now we look at the PMO's annualised return since inception against other key asset classes, cash, equities, bonds, etc. The PMO is the orange line running straight through the middle of your screen, and that, in a single picture, encapsulates what we're trying to deliver for our investors. Regular, reliable income that is uncorrelated to other markets and avoids the volatility that hits some other asset classes so hard. When considered on an accumulation basis, that sort of performance produces a very strong absolute return, as you can see from the graph on screen. Obviously, the PMO was not designed to outperform equities over the long term. We all know that. But when you deliver sort of strong monthly returns so consistently, you compound them, the numbers begin to add up, and that's what this graph shows here. So to summarise, it's still a very difficult time for investors. There is an extended period of subdued global and domestic growth ahead, but to be absolutely clear, in our view, the sky is not falling. The recent turmoil in the car manufacturing industry with SPC, Qantas, Alcoa, that's significant, but it is not the end of the world. Merely sitting in cash is not the answer for investors, and it's not going to be the answer in the next 12, 18, 24 months. The hunt for yield continues. Meanwhile, at Trobe Financial, we've continued to experience strong, sustainable growth. We're performing well for our investors, and we're receiving significant attention and recognition for that. We're absolutely committed to maintaining our organisational strength and stability. So on that note, I'll conclude the formal presentation. I'll use the time available to turn to your questions. Again, apologies in advance if I don't get to your question, but I undertake to follow you up personally after the conference is concluded. So if I turn now to the questions, I see the first question is from Terry. What is La Trobe, and I'll just paraphrase here quickly, what is La Trobe Financial's view on the effect of foreign investors on Australian housing prices? Well, that has received a fair bit of attention in the media in recent times, and we'll just probably make a few quick points about that. First, the Foreign Investment Review Board has to approve each proposed residential investment specifically. Non-residents, so people not living in Australia, cannot purchase existing property, and temporary residents are limited to one existing dwelling, which can be used as a principal place of dwelling whilst they're living in Australia. However, the FIRB typically won't apply a limit on the number of new dwellings or vacant land developments that overseas or temporary residents can purchase. Now, the reason for that obviously is that the FIRB believes that there is a policy good in encouraging development of new housing, which will ultimately become part of the housing stock for Australians. Now, moving from the principles to the stats, the FIRB shows 10,118 real estate approvals in its last annual report, which was for financial year 2012. So these figures are a little bit dated, and it would be good to have some more recent figures. Residential investment totaled $20.9 billion. Now, the ABS has recently stated, just a few weeks ago, stated that the housing stock of Australia is worth approximately $5.02 trillion. So in financial year 2012, overseas residential investment was 0.4 of 1% of the market. Very, very small indeed. Now, whilst there may have been some changes, obviously, since the 2012 financial year, so far we've heard nothing from the FIRB that suggests this process is out of control or that they're being overwhelmed. I would expect, given the attention that we've been receiving in overseas markets and given some recent moves in Canada to, if you like, end their version of the significant investor visa program, I still think there is grounds for us to be watching this space, but the scope of the problem, at least at this stage, is probably overstated. And I just encourage you, whenever you're reading reports on this and the evils of it, just check whether we're actually talking about stats or whether we're talking about anecdotal evidence. Anecdotal evidence isn't, it's not to be dismissed because it may be leading indicators given that our stats are so far behind time. But as Louis Christopher pointed out in his report on this issue not so long ago, it can be very hard to tell when you just look at a prospective purchaser of a house whether they are actually a permanent resident of Australia, given our multicultural society, or whether they are in fact an overseas investor. So to summarise, I guess, that rather long-winded answer, the scope of the problem's probably overstated. It is something, though, that we as a nation should be keeping our eyes on, and it would be really good if we could be getting some more timely stats on this issue. So thank you very much for that question, Terry. Now we've got a second question on a similar topic by the look of it from Lee. And Lee has asked, it looks very similar, are self-managed super funds, SMSFs, over-investing in residential real estate, and so risking their portfolios and driving up prices of houses. Thank you, Lee. In some ways, I'd say my answer is probably the same. Our answer, if you look at it this way, is probably in two parts. First, on the evidence we've got to date, self-managed super funds are not taking on too much debt. People have been asking whether these sorts of investments through what are known as limited recourse borrowing arrangements, by which self-managed super funds borrow, LRBAs, whether these are being too aggressively flogged to unsuspecting SMSF investors. The evidence says at the moment that doesn't look to be the case. Notwithstanding the media hype that we've heard over the last 18 months or so, self-managed super fund exposure to limited recourse borrowing arrangements sits at less than 0.5% of SMSF assets, and that was as at the 30th of September 2013. So that's the ATO stats as at 30th of September 2013. And this proportion, funnily enough, has actually been falling over the last 12 months or so. Looking then at SMSF exposure to residential property, again, that's just 3.5% of SMSF assets. So that's around $18 billion on a $5.02 trillion asset class. Again, probably not the massive problem it's made out to be, and in fact, if you combined self-managed super funds and overseas investors together, you still would be looking at a very small impact, less than 1% of the housing market in Australia. So probably say at this point the panic about self-managed super fund investment into residential property and limited recourse borrowing arrangements is overstated. I would say though, and you know, this is the same point we made about overseas investing, there are still grounds for the industry to be extremely vigilant. Now, real estate investment is obviously excluded as a financial product under the Corporations Act, which means that one doesn't need an AFSL to advise in relation to it, although one probably does need an AFSL, at least according to recent comments from ASIC, to advise self-managed super funds in relation to the purchase of property. So this sort of, should we say, anomaly in the system where we can advise in relation to property investment without an AFSL, that's probably an issue that could be addressed. There's a broad inquiry into the financial services system in Australia under ex-Commonwealth Bank CEO David Murray about to commence. This is probably one area that could fruitfully receive some attention. Again, just to summarise, no evidence of abuse of limited recourse borrowing arrangements as yet or overexposure of self-managed super funds to property, but there are certainly grounds to be vigilant. Now, unfortunately, that's all the time we have today. We do want to keep to our half-an-hour limit strictly, so thank you very much for your attendance. For those who have submitted questions that I haven't got to, I apologise, and we'll follow up those with you personally. But for now, thank you for your time and attention. We very much look forward to continuing to deal with you at La Trobe Financial, and we wish you a wonderful day. Thank you very much.